Good day and welcome to the Laurus Labs Limited 3Q FY23 earnings conference call hosted by Antique Stock Broking. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Just note this conference is being recorded. I now hand the conference over to Mr. Monish Shah from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Vikram. Good evening and welcome to Laurus Labs 3Q FY23 results conference call. We thank the management for giving us the opportunity to host this call. Today we have with us Dr. Satyanarayana Chava, Founder and CEO, Mr. V.V. Ravi Kumar, Executive Director and CFO, and Vivek from the IR team. I will hand the call over to Dr. Satya for his opening comments. Thank you, and over to you, sir.
Thank you, Monish. Thank you for joining us for our Q3 and 9 months FY23 results conference call. We are pleased to have this opportunity to update you on our business progress and answer your questions. Now, let me share quick thoughts on our performance. Our business has continued to perform well both during the quarter and also on 9 months basis, reflecting a sustained momentum across our key growth drivers. We are all well positioned to close the year with strong double-digit revenue growth with stable margins. We remain firmly focused on our strategic priorities to diversify, drive growth, and delivering long-term sustained value to our customers, partners, and our stakeholders. In addition, we continue investing in mechanization, automation, and the digital initiatives to boost operational efficiency. We also like to update that recently Laurus Labs has been selected as a panel supplier by the Global Fund for ARV drug procurement, and the contract will run for a period of 3 years. For over a decade, our company has been committed directly and indirectly to the cause of HIV, and this tender offers us again a great opportunity to make HIV treatment accessible to more than 150 countries through Global Fund and other multilateral agencies. During this quarter, Unit 5 received EIR from US FDA. Moving on to our financial results, we are pleased to report that we achieved a healthy top line and bottom line growth for both quarter and 9 months. We made additional advancements in our R&D initiatives, pipeline enhancement, diversification, and new capacities qualified and ready for commercial production. We are confident in the underlying demand for our portfolio and scale as we continue to see momentum in our business. We have achieved 1,545 crore revenues for the quarter, showcasing a 50% growth year on year. And for 9 months, we clocked revenues of 4,660 crores, a growth of 33% year on year. Our strong results are driven by exceptional growth in our non-ARV revenues, especially CDMO and APIs other than ARVs. Our growth was also supported by much anticipated recovery in ARV formulations, and which is expected to continue further. Our profitability margins have sustained despite ongoing disruption in business environment caused by inflationary headwinds and also geopolitical risks. To begin, I would like to share key updates on our formulation business. Our formulation division has sequentially recovered with 67% growth and reported overall revenues of 747 crores for 9 months, with a decline of 46% year on year. If you look at our Q3 revenue, although there is a degrowth of 33%, but it has seen a healthy recovery over Q2 base and is expected to further normalize during the next few quarters. Coming to LMIC business, While broader demand environment in ARV have continued to stay softer, our business has shown some respite of Q2 low base. But pricing has largely remained depressed. We remain optimistic over a gradual stabilization in the volume uptake ahead. This will be partially supported from open orders and visibility from new Global Fund HIV tender. During 9 months, we launched 2 products, lopinavir and ritonavir, abacavir and lamivudine combinations. Additionally, we are awaiting few more products approvals which should help us in stabilizing business in coming quarters. As articulated in the past, we will continue to evaluate our portfolio choices in this business and play selectively for value over volume alone. Coming to developed market, we continue to perform well across our broader US portfolio despite higher competitive intensity. We continue to get good market share on select products and also increasing volumes for our recently launched products. We continue to leverage our front-end presence in the US market for new product launches. During the quarter, we filed 2 ANDAs, taking the total filings to 5 ANDAs for the 9 months in the current financial year. We intend to make few more filings in the current quarter, and cumulatively we have a total of 37 ANDAs to date. Of these, we have a total of 14 final approvals and 12 tentative approvals. In Canada, we received 2 approvals during the Q3 FY23, taking total approvals to 13, of which we have launched 8 products, and we intend to launch at least 1 product every quarter for the next few quarters. For EU markets, we have validated 3 products as part of the contract manufacturing partnership. We expect a significant upside from these products in the coming quarters. We have a basket of 11 approved products in Europe, of which we have already launched 6, and we will be launching few products shortly. Based on our healthy product pipeline progress, we continue to invest in our non-ARV FDF infrastructure with a total commissioned capacity of 10 billion units. We anticipate that these brownfield capacities that we have added recently should start to get better utilized during the course of next year as we begin to see better demand visibility in ARV business, scale up visible in the partner portfolio, and also key product approvals. On the R&D front, we continue to make good progress and invest in portfolio with product-specific approach based on complexity and economies of scale. We are pleased to share that we filed our first NDA for a HIV pediatric product during Q3. We believe this unique drug product delivery form for pediatric HIV treatment should complement our existing offering, and we continue to do further developmental work on orally disintegrating film platform, which can be leveraged to create innovative pipeline in other therapeutic areas. Our sterile R&D labs, which has already started working on priority projects, and we expect to complete development phase for at least 3 products in the next few quarters. Overall, R&D spending to sales for the quarter was at 3.2%. We have a total of 64 products in R&D pipeline, either under development or under review, having an addressable market of over 40 billion brand sales. So far, we have filed 37 ANDAs in the US, 12 dossiers in Europe, 19 products in Canada, 9 with WHO, 5 dossiers in South Africa, 20 dossiers in India, and 22 products filed in various rest of the world markets. Of the 37 ANDAs filed in US, we have 16 Para IV filings and 11 first-to-file opportunities, having a sizable market. From the beginning, our approach remains product-specific and not market-specific. Coming to the generic API business, our antiviral API sales for this quarter is at 376 crores. As indicated earlier, we expect volumes and pricing are going to stabilize around the current levels. We continue to maintain a leading market share in the current product pipeline and also expect increase in our supplies to developed markets. Onco API business declined 13% during the Q3, but improved sequentially 45%, and we achieved 74 crore sales for the current quarter. For 9 months FY23, the segment has seen a decline of 14%. As you're aware, Laurus Labs have one of the largest high-potent API capacity in India. We're also expanding the high-potent API manufacturing capabilities in Unit 4 to meet continued demand for such products. Our other API segment sales, which include cardiovascular, diabetes, and asthma products, have seen steady ramp-up both for the quarter and 9 months. For the Q3, we achieved a sales of 182 crores, growing at 33% year-on-year. For 9 months, the growth is very robust at 65%, supported by new contract supplies. During the Q3, we filed 3 DMFs, all in non-ARV category. With this, total number of DMFs filed to date is 77. We initiated validation of few APIs and expect to see good potential over coming years. We are also working on CMO opportunities with few global generic companies, and some of them are in advanced stages of implementation at the plant. When it comes to synthesis business, which has continued to sustain robust growth over 200% year-on-year for the quarter, and we achieved sales of 642 crores. During the 9 months FY23, our CDMO business have grown over 2.5x to 1,939 crores. This growth is driven by robust underlying demand from both new and existing clients and our ability to do strong commercial execution. We remain quite excited about this division as we are focused on both commercial execution as well as expanding our pipeline projects in various clinical phases. We continue to work on over 60 active projects at different stages. Ongoing commercial supplies for about 10 products, including APIs as well as several intermediates. Our greenfield investments towards building a dedicated R&D center for this division at Genome Valley and 2 manufacturing units in Vizag is progressing as scheduled. New sites for the synthesis division will have capabilities to handle animal health as well as agro. The facilities will have dedicated blocks for steroids, hormones, and high-potent molecules, apart from large value products. We expect to qualify one of the dedicated animal health manufacturing sites by mid of next fiscal. Laurus Bio revenues were largely muted at 22 crores due to unplanned downtime, resulting to some production deferment during Q3. This has been rectified and brought online. For 9 months, bio sales grew by about 22%. We do anticipate pickup with the ramp-up of new capacities with our large-scale CDMO partners in the coming quarters. We have completed scheduled expansion at R1, including new R&D block, along with balancing equipment. We initiated process for acquiring land for R3 greenfield expansion near Mysore. We believe that the new site should further strengthen our Laurus Bio capabilities in offering CDMO services in animal origin-free proteins as well as growth factors. We believe global opportunity in alternative food proteins is an exciting phase, but this will be a fast-growing segment in the long term. Our focus is to have the right scale, cost, and functionality which will drive our technology differentiation. With that, I would like to hand it over to Mr. Ravi Kumar to share financial highlights.
Thank you, Doctor, and very warm welcome to everyone for our Q3 and 9 months earning call. Total income from operations for the 9 months is 4,660 crores, as against 3,511 crores, showcasing a 33% growth. During the quarter, we have done a 1,545 crores against 1,029 crores, with a 50% growth. Gross margin for the first 9 months is at 55.4%. Our EBITDA for 9 months is 1,307 crores, with a EBITDA margin of around 28%, whereas Q3 404 crores with a margin of 26.1%. A lower margin is due to the negative operating leverage. Our diluted EPS for the 9 months is 12.70 rupees, not an annualized basis, with a 14% growth. Our ROCE is at 26% on an annualized basis on the back of sustained operational leverage across units. Of course, despite of investments into the capex. On the capex front, we invested around 200 crores for the quarter and slightly more than 600 crores for the 9 months. We have guided 2,000 crores capex in the FY23 and FY24. I think we are still committing to around that number for this year and next fiscal. And we believe our capital allocation framework, including commitment towards diversification and strengthening of non-ARV portfolio, building niche capabilities, invest in disruptive technologies, backward integration programs, and improving operational efficiencies will continue to be in force in creating a long-term value. With this, I would request the moderator to open the lines for the Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star followed by 1 on your touchtone phone now. We have a first question from the line of Sajal Kapoor, an investor. Please go ahead.
Yeah, hi. Thanks for giving the opportunity to interact. 2 questions. Given that our CDMO synthesis business will be self-reliant in about 2 years' time, is it fair to expect that management would disclose gross and operating margins, balance sheet, and cash flows in CDMO synthesis separately in FY25? That's one. And secondly, my sense is that once this significant CDMO synthesis capex at Vizag is complete, there will be time consumed in validation batches. There will be an extended qualification period for regulatory audits and US FDA plus other approvals. So there will be a lag before we actually start commercial shipments in a meaningful way. But on the presentation slide 14, it says expect to qualify dedicated animal health unit by mid-2023. So can you help us understand the anticipated commercial shipment timelines for all 3 new facilities currently under construction? Thank you.
Thank you, Sajal. So the 2 facilities for CDMO which are in construction, one is for animal health. The one we will also start construction for agrochemicals. We want to update you. For agrochemicals, we already completed construction of a pilot plant for the registration batches on back. So registration batches already produced in the agrochemical plant. When it comes to animal health plant, currently one NCE program validation was done in a dedicated block in one of the other manufacturing of the parent company. Once the new site is qualified, this will be a new site to be added into the file. And there are some products in some markets, the approval times are shorter. So this site will cater to the global markets, not just US market for animal health. And that is answering your qualification of the programs. When it comes to the separate balance sheet and P&L numbers for the synthesis division, I leave it to Ravi Kumar to answer.
Right now we are using the same common facilities, and it is very difficult to segregate a balance sheet in P&L account. So whatever we can segregate, the revenue only can be segregated. That's how we have showing only the revenue breakdown. Probably in the next three to 4 years, when we have a separate subsidiary, subsidiary, everything under subsidiary, and you will know the balance sheet P&L of this synthesis separately.
Yeah, thanks, Dr. Satya, for your qualification and the commercial shipment response. That's really helpful. Mr. Ravi Kumar, the only reason investors are interested in knowing more about the economics of our CDMO synthesis is that the economics of as a division are significantly better than the rest of our businesses. So when we say that we will have an independently self-sustaining sort of business in 2 years' time, that is FY25, it should also mean that we'll have enough room in the balance sheet to raise external resources if required, but otherwise our operating cash flows adjusted for working capital should be able to sustain the growth momentum of this business going forward, because as we understand, the CDMO synthesis business has a very long runway of growth ahead, and the way Team Laurus has executed in the last 7-8 years, I mean, we were just 100 crore, including the ingredients and the innovator synthesis back in 2016. So we have come a long way, but we are still scratching the surface. So it would really help all investors to have a better color on the economics of this business, and not immediately, but yeah, as I said, 2 to 3 years out. That'd be helpful.
No, I appreciate that point, but the only challenge is because there is a common facilities, the segregation is very difficult. But over a period of time, we will see what best can be done.
Thanks, Ravi. I have more questions. I'll join the queue. Thank you.
Thank you.
Thank you. We have next question from the line of Bharat from Quest for Value Capitals. Please go ahead.
Yeah. Sir, in many forums in the past, you said that ARV business, both API and formulation combined, will be less than 1/3 by FY25. Do you still think that you can achieve this by FY25?
If all our diversification plans goes as we are thinking, it is possible. As you see, for 9 months, our ARV APIs is 20% of our revenue, and our ARV formulations is about 10% of our revenue for 9 months. So that is 35% of revenue came from ARVs, APIs, and formulations in the coming this 9 months period. So we do anticipate rest of the divisions will grow faster than the ARVs. We are hopeful that by FY25, the ARV business will be 1/3 of our business.
Okay, thank you. And currently we have around 5,000 employees, and revenue contribution per employee is around 1.2 crores. In one of the recent interviews, you said that you have vision to double the number of employees, that is from 5,000 to 10,000, and also have revenue contribution per employee from 1.2 crores to 2 crores per employee. May I know, by when you want to have this vision to be achieved?
I think we didn't put a timeline to that.
Yes.
We didn't put timeline, but currently we
are think like in 3 years or 5 years.
6,000 team size now, close to 6,000 team size, and we have added about 20% new colleagues in this current financial year. and about 25% new capacities in APIs, 50% new capacities of formulations were added during the current year. I think we can't give a specific timeline when will be 10,000 team size.
You said only 10,000 team size, not the other one.
Yeah.
Okay, thank you. Regarding this global fund allocation which we got for the period 23 to 25, may I know if the volumes allocated is more than the previous allocation, and also like how much price erosion was there compared to the previous allocation?
We can't give you the price erosion in absolute terms or also volume in absolute terms. We got fair share of business. We are not the lowest bidders in the tender. That much I can tell you. Yeah.
Okay. Thank you. That's helpful. And also, sir, there's a sharp jump in number of active projects in CDMO. In Q2 presentation, it was mentioned as 50, and now in the latest presentation, it is 60. So there's an increase of 10. May I know what led to the sharp increase in the number of active projects?
We got awards for clinical supplies, and we expect this number will continue to grow. Yeah.
Okay. Thank you. And my last question is, you have increased this API capacity by 1 million, I guess, in Q3, and also are planning to increase another 1 million in Q4. That's almost 2 million increase in API capacity. May I know which division will use this additional 2 million liters? Is it for non-ARV API or for captive FDF or for CDMO?
It's a very interesting question. Most of the increased capacity will be used for non-ARVs.
Non-ARV API, you mean the other APIs, is it?
Yes, other APIs and CDMO.
And CDMO.
Yeah.
Okay. Thank you. And one more question, if I may. So I see that in the investor presentation that there is a new capacity planned for Laurus Bio adjacent to R2. So is it a brownfield expansion of R2 we're talking about here?
See, in R2 Laurus Bio, we had a mismatch of downstream processing when it comes to upstream processing. So we are debottlenecking that. We have taken land adjacent to R2. So with that, our output will go up. Our upstream capacity is much larger, downstream is less. So we're removing that mismatch because we know what products from the CDMO partners. We have a better visibility how much downstream is needed. We are doing that. Our real expansion will happen in R3, where we have identified and paid advance for land near Mysore. Yeah. So that will be the real expansion where eventually that site will have a 2 million liters of fermentation capacity.
Exactly. So this R3.
I'm sorry to interrupt, Mr. Bharat. Would you like to come back in the question queue?
Okay. Thank you. Thank you very much. Yeah.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, kindly restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. We have next question from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi sir, good evening. I have a couple of questions. My first question is on the formulations business. In 9 months, the business has roughly declined by around 45%. Can you give some understanding how much of this decline is attributable to ARV formulations and how much of this is attributable to non-ARV formulations?
Close to 2/3 is ARVs, 1/3 is non-ARV.
2/3 ARV and 1/3 is non-ARV. Okay. And what is the reason behind the decline in non-ARV formulations? I mean, although many other export-oriented companies have also been reporting soft numbers, is it something to do with destocking or more competition in the markets? What are the reasons? Can you pinpoint why the non-ARV business is also under pressure in the formulation side?
Our formulation contribution from non-ARVs was around 20-25%. because of ARV revenues were less, the percentage-wise non-ARVs contributed to 1/3. But otherwise, we didn't see a decline in non-ARV formulations in absolute terms.
Okay. Okay, so this entire decline is basically the ARV formulations piece then?
Yes.
Okay, understood. Also, sir, in your investor presentation, you have mentioned that the FY25-26 goal is to have more than 25% revenues from synthesis. Now, I'm not sure what over 25% means, and that it could be 25-30%, it could be more than 30% as well. But it does seem that from 42% odd in 9 months FY23, this number is going to decline, the synthesis contribution. So the question here is that what happens to margins in this case if your custom synthesis contribution will go down over the next couple of years? Because the broader understanding is that custom synthesis is usually the higher margin business. So does it imply that the margins could be in some sort of a pressure over the next couple of years?
So when we are looking at our investor presentation outlook slide, that was the goal. Over 25 doesn't mean it will come down to 25. So that is the goal we wanted to keep for our internal. That's already achieved. You can consider that the goal is achieved much earlier than FY25. This goal we put when our synthesis revenues were contributing 18% to our revenues last year.
Okay. Yeah, but since intuitively, I mean, this is a very strong year for the synthesis business in FY23. I'm not sure if they're calling out the level of unsustainability in this scale in FY22. The absolute contribution should only go down in 24 and 25, right? So wouldn't that imply that margins should be under pressure in next couple of years?
Are you there in the line?
Yes, I am there.
Okay. So the in FY25 when we say 25%, so it is on the increased revenue of FY25, right? So it's in absolute number. This will be much higher than what it is today.
Okay. Okay. Understood, sir. Okay,
Yeah.
Thank you.
Thank you. We have next question from the line of Krish Mehta with Enam Holdings. Please go ahead.
Hi, thank you for taking my question. So I just had two questions. One is on what was the absolute ARV revenue for this quarter?
Absolute ARVs for this quarter APIs is 367 crores, 376 crores for APIs, and 140 crores for the formulations. About 516 crores. About 1/3, 36%, 35% of revenues came from ARVs, APIs and formulations.
Okay, and what was ARV FDF for this quarter?
140.
Okay, thank you so much.
Thank you. We have next question from the line of Surya Patra with Phillip Capital. Please go ahead.
Yeah, thanks for the opportunity. So I just wanted to understand freight cost or to understand the cost equation better. Sir, what is the share of the overall cost would be freight cost, and what would be the rise in the energy cost for this quarter over last year, if you can share that?
Freight cost, I think if at an overall level, it could be very insignificant. It's not very significant.
Okay. Any specific reason, sir? I think generally freight cost is around mid-single digit kind of number. And last year, the way it had appreciated, so that was become a kind of important number. Or I'm reading slightly differently.
Most of the export sales happen in in the sea by sea. If it is by air, actually I agree with you that the costs are too high. So it will impact. Most of the sales happens through by sea.
Even the freight cost, sea-based freight cost had
gone up significantly, but when it comes to percentage to revenues, it's not very high. It's not very high.
Okay, sure. In terms of
you were asking about the power cost increases.
Yeah.
During the first quarter, we have seen significant rise in the energy cost because of lack of power in our industrial zone. We did buy from private power, which was expensive at the time. But now situation improved, and we are not buying any private power higher than the grid power cost.
Okay. Sir, if I just compare the FY22 energy cost number versus FY21, so then during 21 it was 2% of our revenue was energy cost, which became 4% in the FY22. And it is believed that FY23 numbers are much higher, obviously, than FY22. So that is why I was trying to understand whether it is now around 5-6% of the total cost.
No, in the energy cost, not only power, actually the coal cost also there.
Yeah.
In the middle, the coal prices have also shoot up, and then now the coal prices also become normal. So I think that kind of a substantial increase is not there, but definitely increase is there. But if you need a specific percentage, actually we will let you know.
Sure, sir. My ultimate question was that even this quarter performance, if you see, the gross margin has sequentially come down, although you have indicated that the product mix would have to some extent impacted. But if you see the revenue mix, there is not much change sequentially. And there is a 2% kind of gross margin erosion. And on the other expenses front, if I see, from the pre-COVID level, now it is almost like 4% kind of a rise. So these two things I wanted to understand a bit. If you can elaborate, that is fine.
Yeah, we'll try to answer the question. So when it comes to the decline in gross margin, that was primarily driven by the ARV, APS and formulations. But we don't expect further decline in ARV, APS and formulations. As the revenue from other divisions increase, so the margins will continue to go up. We don't expect the margins will come down further.
Okay. About other expenses, if you...
Other expenses higher because of several new capacities were qualified in API as well as in formulations. As you know, company's philosophy is to expense all pre-operative expenditures. There is an operational deleverage. Yeah.
Okay. Sure, sir.
Thank you. Ladies and gentlemen, please restrict questions to 2 per participant. We have next question from the line of Tushar Manudhane with Motilal Oswal Financial Services. Please go ahead.
Thanks for the opportunity. So just extending previous questions, so how much would be the operational cost related to this expanded formulation facility of 5 billion?
We can give you, the new block has about 300 colleagues right now. So we can't give you the specific number, but I can reiterate the company's philosophy is to expense all those. Yeah.
Okay. And so just secondly, given that we are sort of exploring CDMO across 3 fronts, pharma, agrochemicals and animal health, if you could elaborate, what kind of asset turn margins of the return ratios you would have sort of thought about when utilizing the let's say, the capital allocation for CDMO across these three different spaces?
Based on our current understanding, the animal health and human health CDMO have similar return ratios, whereas agro asset turnover is higher, but the margins are a little lower when compared to this. But when you multiply asset turnover and margins, I think return ratios could be similar.
And in terms of opportunities, in terms of the developments happening across animal health or the agrochemical in particular?
Animal health is a fixed portfolio right now. We know what to make, how much to make, what price and all. It is with one customer, animal health entire program. Whereas agro, we already have two, and it's a limited portfolio right now. We are exploring further. Yeah, we'll give you more details as and when we are in a position to share.
Sure, sir. And just lastly, while you said that the margins would be stable, so given that 9 months we have 28%, but for Q3 in particular we are down to roughly 26%. So does it mean that we would be expecting a good uptick in the margins for the fourth quarter?
For the next year, this year will be closer to 28 probably. But next year, because the one reason why we are confident is we don't expect further price drops in ARV, APIs or formulations. So, and we don't expect significant growth also. The segment which are growing have higher margin than ARV, APIs and formulations. That's the reason our belief the margin should improve. Yeah.
Sure. All right. Thanks.
Thank you.
Thank you. We have next question from the line of Devrat Mohta with Capital International Inc. Please go ahead.
Hello.
Please go ahead, sir.
Hello. Yeah,
Hi.
Doctor, hi, Devrat here. I had one question. I wanted to just follow up on margins. If you look at the export data until Q2, you had this big benefit from certain intermediate which you were supplying, which it seems like that the intermediate probably demand for that will probably fall off quite significantly as we go forward. If I look at the numbers, roughly let's say 400 odd crores of revenue from that one intermediate, and if I work with a 40% EBITDA margin assumption on that single product, I mean that basically means that the underlying business was probably low 20s EBITDA margin this quarter. So what gives you confidence that if that product goes away as well, that your margins hold up at 30% versus the underlying margin kind of low 20s now?
As you might have seen, the active projects have increased from 50 to 60, and we expect that number will go further. So there are projects which are not one-off in our CDMO. So that will drive our growth.
And secondly, sorry, go ahead.
Sorry, Ravi, go on.
What will be the negative operating leverage which was pulled down the margins this year? And when we have a better operating leverage, that also will improve the EBITDA margins there. Devrat, are you there?
Yes, I'm there. I lost you for a second though.
Okay.
Okay. Yeah.
So do you have any further questions, Mr. Mohta?
No, that's it from me. That's it.
Yeah, thanks.
Thank you. We have next question from the line of Harith Ahmed with Avendus Spark. Please go ahead.
Hi. Good evening, sir. Thanks for the opportunity. You mentioned in your presentation that you've been selected as a panel supplier in the Global Fund tender. So what exactly does it mean, being a panel supplier?
See, they allocate majority of their procurement percentage of their procurement. So we know how much percentage we are getting global procurement for 23, 24, and 25. So these panel suppliers will have assured quantity from Global Fund.
Okay. And then will you be able to share the percentage allocation?
No. We can't share those numbers.
Okay. So last quarter, you had, after revising your guidance, revenue guidance for FY23, you had lowered that number to around 6,500 crores. Do we still maintain that guidance for FY23 revenues? You mentioned strong double-digit growth.
We were working towards that.
Okay. And this NDA that you filed for this ODF technology-based product, is it a PEPFAR filing or is it a normal NDA for the US market?
I think eventually we will sell that in developed markets as well. Yeah. See, right now this oral film is not there in the guidelines of WHO. So they will put into the guidelines once we get an approval from FDA. Yeah.
Okay. Last one from my side. This supplies under the purchase order. Can you share some directional sense versus 2Q? Was it maintained at the same level, or did we see a very sharp decline in the supplies? And how we should think about the fourth quarter and FY24 for this particular contract?
We can't share details on the contracts.
Okay. Thank you, sir, for taking my questions.
Thank you.
Thank you. We have next question from the line of Ananda Padmanabhan with PGIM India Mutual Fund. Please go ahead.
So thanks for asking my question. Am I audible?
Yes, you are, sir.
Yeah. So if I couldn't understand your response to the question of the earlier participant with regard to the guidance for the full year basis. So what is the current visibility that Laurus has based on whatever contracts that are in hand in terms of achieving that guidance of 6,500 crores on a full year basis?
We are hopeful to meet that.
Okay. And with regard to the CDMO business, you said that even though that one contract for those supply of intermediates to run off, you have other contracts which you see good visibility. So how should we look at the current run rate? So if I look at the average CDMO run rate, it comes to around 650 odd crores. So should this be taken as the base business run rate for the CDMO business going forward for FY24, or one should work with a much lower number?
CDMO business for anyone is a lumpy business. Yeah.
So I'm thinking on a full year basis. So if I just analyze it.
So what we have to look at is, are we getting new partners into CDMO? We have added 2 new big relationships in this current year, and the number of active projects has gone up from 50 to 60. And we are building dedicated capacity for CDMO, and we are building a dedicated R&D for CDMO. All those should clearly indicate that we have very high focus on this segment, and all the investments happening in the company are to support this sustained growth.
Okay. And final question with regard to the margin. So when we come to the next year, we would see that the contribution from ARV business would go up as your ARV formulation revenues picks up. The CDMO, while that could be lumpiness, but in all probability, CDMO's a percentage of revenues will start coming down. Inherently, the business mix would be business mix would be inching towards more lower margin business than what it is currently. So should we work with much lower margins for FY24 than what we have achieved in the first 9 months of FY23? Or are you of the opinion that the current margins of FY23 on a 9-month basis, whatever we have achieved, is something that is still sustainable?
I think we'll give some flavor during our year finance results. We can't give you any guidance right now.
Okay. But from a longer term basis, beyond FY24, if all your projects work out, you're confident that you'll be able to maintain the current margin profit.
That's for sure, yes.
Okay. Thank you. I'll get back to you.
Thank you.
Thank you. We have next question from the line of Nitin Agarwal with DAM Capital. Please go ahead.
Sir, thanks for taking my question. Sir, on the CDMO business, in your assessment, animal health and the crop protection business can comprise of what proportion of our CDMO business over the next 3-4 years? Currently, I presume all our CDMO businesses are on human health only.
Our CDMO business is also well diversified, Nitin. So we have a portfolio of steroids and hormones. That's business very stable right now. And our human health side is growing very well with NCE programs. And we also have CMO for dietary supplements and cosmetic ingredients also. That is also growing very well. And animal health, we are seeing very small base right now, but once the facilities are qualified, that division will grow. And crop production, serious revenues will come only in FY26 actually. Yeah. FY25, not before. The only facilities we are constructing and qualifying, nothing will come. Yeah.
These two segments have the potential to be what? 1/3 to half of your CDMO business, or will continue to dominate by human health only?
It's too early to give a number in that direction. Yeah.
Okay, sir. And sir, secondly, with the new developments that have happened on the ARV tenders, how do you look at your 3,000 crores per annum guidance for ARV formulations and APIs? Are we in a position to exceed that, or it's going to be you still see that's going to be an optimal number where we'll be operating the business at?
We lowered that number to 2,500, both APIs and formulations. I think we are pretty on target for that.
And so even on a going on basis, you don't see increase happening to that much beyond this?
If growth comes, we are okay. Even if growth doesn't come, we are okay. Because we are not adding any capital allocation to ARVs, either APIs or formulations. We are putting more focus on high margin, high growth business rather than trying to run around with business which stabilized. And there is not much growth. Even we are not anticipating.
Okay. And sir, when you talk about this ARV business guidance, do you take into account this new NDA that you filed over the last 2 quarters? Do they have the potential to add meaningfully to these numbers, or they will be part of this overall mix only?
I think depending on how WHO put guidelines for pediatric treatments, we are also developing a portfolio of films, not just ARVs in other therapeutic areas also. I think this platform is very exciting. We're adding more products there.
Okay, sir. And then lastly, on the other API segment, we've had pretty strong growth in the last 2 quarters in particular. Any particular reasons, why, any one-off, any non-recurring elements in this number, or this is like a new base on which the business goes on from here?
This is based on our product portfolio. Our diversification efforts are giving results. So, yeah.
Okay, sir. Okay. Thank you, sir.
Thank you. We have next question from the line of Kunal Dhamesha with Macquarie. Please go ahead.
Thank you for taking my question. So first one on the global fund allocation that we have got. So while we have some clarity in terms of the volume allowance for the next 3 years, the pricing at which it would have happened, would it remain stable going forward, or there will be annual revision on that?
Prices will be stable. Yeah.
So whatever prices you would have bid would be the price that would continue till 2025, or there'll be like next round of bidding which will happen maybe 1 year down the line?
The pricing already depressed. We don't expect prices will go down further on this.
Okay. And second question, given my belief is that the API facilities are generally fungible, except for a very different chemistries. And given that the ARV API seems to be going down probably in terms of pricing, and hence the return ratios or whatever capacity that we employ would also be going down. So why then go for new capacities for CDMO business, and why not just utilize rationalize some of the ARV portfolio where we are not making that much return, and then just utilize that kind of API capacity?
It's a good question, but if you look at the size of the ARV business, both API and formulation, is not so small. It is significant. So we don't want to divert the ARV facilities to CDMO. CDMO we are building anyway. Yeah.
So then the other way to maybe just my final question is whatever capital we would have invested in ARV business, would have we got that back by now in terms of the payback, or let's say over next 3 years that will happen in terms of payback?
Just to give you overview of capacity utilization of ARV facilities is pretty good actually.
Mm-hmm. Okay. Perfect. Thank you.
Thank you.
Thank you. We have next question from the line of Jeevan Patwa with Sahasrar Capital. Please go ahead.
Thanks a lot. So I think, Dr. Satya, what's happening is basically I just want to understand whether we'll be able to maintain the gross margin at the 54% level and above for next year and onwards when we basically start the new FDF formulation contracts, both ARV and non-ARV. Because if you are able to maintain 54% gross margin, I think we will be able to maintain even the EBITDA once we get the operating leverage. So the question would be, will you be able to maintain the 54% kind of gross margin and above?
Currently, where the operational deleverage is happening, once the operational deleverage is over, and then the margins profile will improve. Yeah, EBITDA margin.
So basically, I just give you the overview where I'm coming from. So if I just look at the best quarter that we had, Q4 FY21, we had similar gross margin of 54%. But that time our employee cost was 6% and our other expenses of 14%. And that's how we actually reported 34% EBITDA margin. Now what is happening is our employee cost has gone up to almost 9.5% and other expenses gone up to 18.5%. And that's where our EBITDA margin is down. So once we have the operating leverage and we are able to utilize our capacities better, so if we are able to give run rate of say 2,000 crore and quarterly run rate, I think we'll get back to that EBITDA margin again. But we need to maintain the gross margin of 54%. So that's where the question is whether we'll be able to maintain a gross margin of 54%. Gross margin, I would say.
I think it all depends on the product mix and then the business division mix also, right? So it all depends.
Right. So we are starting new orders next year, right? Both ARV and non-ARV formulation orders.
Correct.
We'll be able to have this kind of gross margin.
Given your point is well taken, the employee benefit expenses was FY21 was 9%. For the current 9 months is 10%. Whereas other expenses was 14% and current is 18%. Yeah. So there is a lot of deleverage is there, and we appreciate your view that if leverage starts kicking in, even the margins are stable, EBITDA percentage will go up.
He's talking about gross margin.
The gross margin remains same. Yeah. Leverage kicks in, then EBITDA will go up.
Correct. So that gross margin, so the question basically, will be able to maintain the gross margin 54% and above?
Yes, hopefully. Yeah.
Okay. Thanks a lot, sir.
Thanks.
Thank you. We have next question from the line of Hussain Qadri with Ambit Asset Management. Please go ahead.
Hi, thank you for taking my question. Sir, my question is with regards to our non-ARV formulation division. If I see that we must have done roughly 278 crores in the first 9 months, and I remember that most of our capacity, what we have, 10 billion, out of that, I think around two-thirds is towards non-ARV formulation with further capacity or brownfield addition of 5 billion possible. So here, I just wanted to get a sense of the division between how much of this revenue, what we are doing currently, is CMO based, and how much would it be on the basis of the ANDAs which we have filed. This is because mainly I wanted to understand the strategy going ahead, that will we be focusing more on CMO side or probably go more after the ANDAs which we are filing? So yeah, that's the question. Yeah.
So the current capacity utilization is over 50%. Maybe I would say number of the 10 billion is qualified. Currently we are at 6 billion usage. Out of that, 1.5 billion is CMO.
Sorry, you said 1.5 billion is CMO.
Yeah. 25% of capacity is used for CMO.
Okay. And is this what going ahead, will we focus more on the CMO part, or is it more on the our launching our own products in the market? I mean, how do we distinguish between that strategy going ahead?
I want to clarify one point here. When we are saying CMO of formulations, we are not offering CMO for our formulations unless we make the API. So for the formulations, we also make API, even the CMO.
Okay. Got it. All right. Thank you.
Thank you.
Thank you. We have next question from the line of Palak Shah with Infina Finance. Please go ahead.
Hi, sir. Thank you for taking my question. Just one from my end on your synthesis business. So given the number that you have reported, does it have any new contract that we have recently won in last 2 quarters? So the contribution, despite of one-off project going off, it's still at 650 crores.
We have a healthy pipeline in our CDMO. Several new active projects kicked in, and that looks very promising. We can give you that details.
Okay, but if I clarify a bit, would that mean that the annual quarterly run rate of 120 to 150 crores that we stood total date actually jumps to 350 to 400 crores now, or even above that?
There are a lot of active projects. I go back to my statement. A lot of active projects. We can't give you specific number right now.
Got it. So thank you so much for this.
Thank you.
Thank you. We have next question from the line of Sajal Kapoor, an independent investor. Please go ahead.
Yeah, hi. Thanks a lot. Question on sterile injectable. Last year we commissioned our sterile injectable R&D labs, and we started working on few priority projects. So as a broad long-term vision, where can we go in sterile injectables in terms of commercial scale over the medium term of say 3-4 years? That's one. And then quick question on Laurus Bio. So I heard about this debottlenecking at R2 to enhance the downstream and resolve the mismatch between the upstream and the downstream, which is a common phenomenon in biotechnology. So what's the anticipated sort of timeline for this completion of debottlenecking in the next sort of plant or land that we have acquired? And on R3, are we still on track to get to 1 million new capacity by FY25? Thank you.
I think I will answer your last question first. So in the bio, debottlenecking at R2 will be completed in the next 6 to 9 months. Yeah. Construction already started. When it comes to R3, we will do, instead of 2 phases, we'll plan to do 3 phases to go to 2 million. Probably we'll do less than 1 million in phase 1, maybe around 650,000 liters. So 3 phases, 3 equal phases, 650,000 each to go to 2 million liters instead of 1 plus 1. That's the current plan in R3. We are at the design finalization phase right now with R3. Once the construction starts, we expect it will take between 18 and 24 months to go commercial.
Sure. And on the sterile injectable, if you could just shed some color on the medium term.
We started several projects in R&D, and we are yet to start the construction of commercial facility for sterile products. We have taken land, but construction not started yet.
And in terms of the commercial scale, 3, 4, 5 years out, do we have a sort of a rough sketch in terms of how big we want to be in this area over the medium term?
We have a plan in place. Yeah.
Right.
We will
That's very helpful.
More details when we complete R&D stability and then ready to go for commercialization.
Yeah, of course. And we have always followed that approach, R&D first and commercial manufacturing later. So really, really happy to have all those responses, Dr. Satya. I wish the entire team very best. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. And I'd like to hand the conference back over to the management for closing comments. Over to you, sir.
Thank you, Manish, for organizing this call, and thank you, the participants, investors, for your active participation and very insightful questions. Thank you. Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your line.